So how's the economy doing? So the Fed just had its meeting on January 29th. They've come to the conclusion that the unemployment rate has stabilized. It's still fairly low. The economy is still expanding. That's good news. The problem now is inflation remains elevated, and we'll get to that in a little bit. So because of that, they can't keep dropping interest rates. So they're going to hold interest rates at 4.25 to 4.5% at the moment. Now, they are likely to hold again in March, but they have to wait to see the economic data and see what's going on with that. So Jerome Powell said, basically, it's difficult for workers to find a job these days, and it's a low hiring environment. So those aren't great for the labor market, but they can't keep dropping interest rates because if they do, then the inflation rate will go up. So the job openings, basically this is declining. The unemployment rate, this increased from 3.4% to now 4.1%. That's still historically low, but it did trigger the SAM rule. Basically, that's to give an early indication that you could be in a recession already. But being that we were at historically low unemployment, it just may be an artifact of that. So we'll have to keep an eye on that. So the unemployment claims, this is kind of interesting because initial claims are fairly stable. I mean, they're bouncing up and down, but it's within, reason. But for those workers that are on long-term unemployment, this number keeps going up. So once people get out of the workforce and they're trying to find a job, they're having difficulty finding those jobs. So that's going back to that comment up there. So your CPI, basically your inflation, if you look at core is, if you exclude food and energy from the calculation, it's stabilizing about 3.2%. It doesn't seem to be moving any further down. So that's a concern for the inflation. So that's why it's remaining elevated. And why is that considered elevated? The Fed has a target of about 2% inflation. So they want to bring that number down, but they need to keep maximum employment. So they don't want to raise interest rates right now because that may lead to job losses. But they don't want to reduce interest rates because that'll lead to more inflation. So they're in a bit of a tough spot. They'll leave it here for now. Now, if you look at all inflation, that includes your food, that includes your energy, this is going up. So these are moving in the wrong direction, or they're stabilizing at a higher level than what the Fed would like to see. For real GDP, fourth quarter results came in. We've had positive 2.3% growth. So it's positive. You're not in a recession. Recession is typically you have 2 negative quarters of GDP with unemployment and some other things as well. An area of the economy that's a bit of a concern, the U.S. manufacturing, which is tracked by the PMI. This has been in a decline since late 2022. And you can look at this chart. What you'll see is anything below 50, basically that manufacturing sector is shrinking. If you also look over the last year or so, it's been losing maybe like 5,000 to 10,000 employees per month on average. So that's a lot of people losing their jobs, especially in the manufacturing sector. Another thing people look at, the 10-year and the 2-year. So this yield curve has uninverted, and everybody's like, hey, it uninverted. So that's good news. Well, generally, it's inverted, and then just before you hit a recession, it uninverts. So that would be similar if you look to the chart. Right before the 2001 dot-com recession or the 2007 Great Recession or the 2020 pandemic, all of these had a yield curve inversion, and then it uninverts just prior to a recession by several months. So over the next year, there is a potential for a recession. It's not a huge potential, but some of these are going in the wrong direction. So what am I doing to prepare? As long as I have an emergency savings, I'm not panicking, even if something happens. I'm, more than a decade away from retirement, so I'm going to keep it invested. I make sure I have, around a 6-month emergency fund, and that would be mostly in CDs or high yield savings around 4% yield. So I'm still earning something. You want to make sure you keep up with inflation at the very least. I'm still dollar cost averaging. I'm still buying and investing in stocks like the S&P 500. And when I get close to that time, when I think it is occurring, what I'm going to do is either buy some put options or invest in some very short-term inverse ETFs, where I've done that in 2020. It's worked out well for me before, where I can get, maybe 5 times whatever the money I put in. But I won't risk my entire portfolio on that. It's just a small percentage. If you're interested in learning how to make more money, how to save, how to invest, how to take advantage of taxes, please subscribe to this channel for you. Have a great day.